Let's talk about capital markets. A capital market is a financial market in which long-term debt, which is over a year, or equity-backed securities are bought and sold, in contrast to a money market where short-term debt is bought and sold. Capital markets seek to improve transactional efficiencies. These markets bring suppliers together with those seeking capital and provide a place where they can exchange securities. The best-known capital markets include the stock market, the bond markets, and the currency and foreign exchange markets. Most markets are concentrated in major financial centers such as New York, London, Singapore, and Hong Kong. Financial regulators like U.S. Securities and Exchange Commission, or SEC, Bank of England, and others oversee capital markets to protect investors against fraud, among other duties. There are primary and secondary capital markets. Let's see the difference between them. In primary markets, new stock or bond issues are sold to investors, often via a mechanism known as underwriting. The main entities seeking to raise long-term funds on the primary capital markets are governments, which may be municipal, local, or national, and business enterprises or companies. Governments issue only bonds, whereas companies often issue both equity and bonds. The main entities purchasing the bonds or stock include pension funds, hedge funds, sovereign wealth funds, and less commonly wealthy individuals and investment banks trading on their own behalf. In the secondary market, existing securities are sold and bought among investors and traders, usually on an exchange over the counter or elsewhere. The existence of secondary markets increases the willingness of investors in primary markets, as they know they are likely to be able to swiftly cash out their investments if the need arises. A second important division falls between the stock markets for equity securities, also known as shares, where investors acquire ownership of companies, and the bond markets, where investors become creditors. Let's also discuss the difference between money markets and capital markets. The money markets are used for the raising of short-term finance, sometimes for loans that are expected to be paid back as early as overnight. Capital markets, in contrast, are used for the raising of long-term finance, such as the purchase of shares, equities, or for loans that are not expected to be fully paid back for at least a year. Funds borrowed from money markets are typically used for general operation expenses to provide liquid assets for brief periods. For example, a company may have inbound payments from customers that have not yet cleared but need immediate cash to pay its employees. When a company borrows from the primary capital markets, often the purpose is to invest in additional physical capital goods, which will be used to help increase its income. It can take many months or years before the investment generates sufficient return to pay back its cost, and hence the finance is long-term. Together, money markets and capital markets form the financial markets.